Are you moving up or downsizing at the end of your mortgage term? Buying one property and selling another? You're going to want to see this one. First up is transfers. Transfer happens when you reach the end of the term of your mortgage, the 5 years or whatever, and you're not planning to move. See, what happens is that the mortgage technically is due in full with your existing lender, but this gives you the power to negotiate. The way it works is that you can renew your mortgage with your existing lender, or you can take it to another lender. Because you're at maturity, there's no penalty to break the mortgage. Technically, you aren't even breaking it. What you can do is go to another lender and do it as if it were a whole new mortgage. Now, what's cool about the transfer program in particular is that if you're at the limits of qualification for your mortgage, often you're grandfathered in at the old policy when your mortgage was originally done. A couple of the cool features of the transfer program are that because your mortgage is coming to a maturity, there is no cost to break it. Technically, you're not even breaking it. Now, there is a legal cost involved in order to rewrite the documents, but generally the new lender is eager to have you as a new borrower, and they'll pay the legal fees. In cases where they don't, oftentimes even your broker will pay them. So it doesn't cost you anything, you just get a better interest rate. Finally, the transfer program can work for mortgages not coming to maturity as well. In some cases, it would make sense to break a mortgage, pay the penalty, and take it to another lender. This would happen sometimes when you have, for example, a variable interest rate, where your penalty is not too small to break it, but you could get a fixed rate with another lender that's really low and lock it in for 5 years. It's all up to you, but either way, it's a great program. Normally, when you sell a home, completion isn't exactly on the mortgage maturity date. In those cases, you generally have to break a mortgage, pay a penalty, and then do a new mortgage with a new lender for the new house. That's where ports come in. Ports let you avoid the penalty, and if you've got a great mortgage already, keep the existing mortgage and just move it over to the new house. Now, to be certain, not all mortgages are portable, especially in the case of variable rate mortgages. They often will have to be converted to a fixed and then ported over. You'll still be liable for legal fees. After all, titles are still changing hand. However, you can move the mortgage, payment, and interest rate all over to the new lender. Now, you have to be careful because different lenders have different port policies. Even within the same lender, different products will have different port policies applied. For example, it's very common to have a fixed rate port product but not have a variable rate portable product. When you're moving your mortgage payment and interest rate to a new lender, you really have to be careful to understand what policies apply. Now, it's very typical that when you buy a home and sell a home, the transactions don't happen on the same day. Lenders allow for this in their port policies and typically will allow anywhere between 30 and 120 days in between transactions. Often you have to understand too, if you do the sale first and buy later, they often will charge you your penalty when you sell the old home, and then you get reimbursed when you fund the mortgage on the new home. What we've been talking about so far is what's known as a straight port. This is when the mortgage amount doesn't change. However, often lenders will allow a port increase or a port decrease, or even a port plus a second. When you're upsizing and require a bigger mortgage, you're normally going to have to do a port increase or a port plus second. The way a port increase works is that it's referring to the mortgage size. Basically, the mortgage gets bigger, which affects both your interest rate and your payment. The interest rate preserves all your old money at the old rate, but any additional amount is negotiated at current rates. So you wind up with a weighted average interest rate, which often will run into several decimal places. In some cases, term and amortization changes are also possible, which will affect the rate as well. When you do a port increase, full requalification is required. If qualification policies have changed since you did your original mortgage, you can run into difficulties. So again, you got to be careful. The alternative to a port increase is a port plus second. In some cases, some lenders will allow you to do a second mortgage in behind your existing first mortgage. The first mortgage gets done as a straight port, but then a second mortgage is added in behind. Now, this second mortgage often will behave like any other second mortgage with an amount, regular interest rate, and payments, or even as a line of credit. However, some lenders have a specific product that goes in behind their first. These products are great because they often will give you a preferential interest rate and make the whole process work much better for you. The third type of port is a port decrease. Port decrease is the exact opposite of a port increase, except that you're downsizing, decreasing the size of your mortgage, so your payment is going to decrease as well. Normally the remaining term and the amortization remain the same, as well as your interest rate. Now, port decrease, you also have to be careful, because if you're doing a big port decrease and you exceed your prepayment penalty allowance, you might end up paying a penalty on the part that you decrease anyway. Port decrease may not always make sense, especially if you're towards the end of your term, because in those cases the penalty is usually quite small. Now, the alternative to a port or breaking a mortgage is an assumption. In the case of an assumption, what you do is you actually sell the mortgage along with the home. The new buyer obviously has to qualify for the mortgage, and you have to be sure that your mortgage is assumable in the first place, but can make sense for someone who's selling a home and not buying another, such as in cases where you're moving to an old age home or moving out of the country. Note that in any of these cases, a port or an assumption, port increase, port decrease, you still have to pay your legal fees, appraisals, and all the rest of it. If you've made it all the way to the end here, congratulations. And I got a super secret bonus for you. If you're selling your home and breaking the mortgage, and you're not porting it, and you're not letting it be assumed, you still pay the penalty, but I can save you thousands of dollars. In the case where you have an insured mortgage and you're getting a new insured mortgage, you can generally take the premium from the old insured mortgage and have it applied to the new insured mortgage. Now, you don't get the full amount you pay, and it doesn't always work, but it's worth asking the question, because I've saved clients thousands and thousands of dollars doing it. Thanks for watching. Have a great day.